Hello, everyone. It's Wayne Best, Chief Economist at Visa. And welcome to the first in what we plan to be a series of touch points for you to hear from my team of economists on how we're viewing the latest business and economic trends. Now, to kick it off, I thought I'd have each of our leads globally and in regions say a few words on what's top of mind for them as we look ahead into 2025. I'm joined in the studio today in San Francisco with Richard Lung, Principal Global Economist who covers cross-regional trends and developments. Happy New Year, Richard.
Happy New Year, Wayne.
You know, Richard, as we think about 2025 and the global economy, tell me more about what you see as some of the key trends or things that we should be looking at and focusing on.
Well, Wayne, to look forward into the new year, I want to go back to what we saw last year. We have a unique tool, the Spending Momentum Index, which covers 100 countries around the world.
That's an expansion from what we had previously. So
Definitely.
we've really blown this out over the last year.
And, it gives us a unique view into a whole range of countries and how consumers in these countries are responding to different economic actions. And what we're seeing is that, the year started strong last year. It petered out towards the middle of the year, but it started to recover as we came out of the year. So we're thinking there's going to be a pretty good, strong uptick in momentum as we go into 2025. Now, with that momentum, what we're looking at is growth being about 2.8% on a global basis this year.
Now, that's not terrible. I mean, that's certainly pretty robust. Under 2% would generally be considered a global recession. So we're certainly performing well better than that over that period of time. It's also interesting to see it's kind of the changing mix of around the world of what's happening. And specifically, those countries, many of the emerging economies that actually raised interest rates earlier than others did during the pandemic, actually ended up resulting in lowering their rates a little earlier. And those are the areas we're seeing some of the growth versus, say, some of the advanced economies.
Certainly. And when we get to Latin America, that will be one of the topics we'll cover. Now, these forecasts that we're talking about, they assume that inflation and interest rates continue to soften. We're expecting that they should continue to fall, which should help consumers and businesses regain their footing in 2025. This relief is coming just in time. In Canada's case, what we're seeing is that businesses had struggled over the past year. Households had really contended with the mortgage rate resets that were occurring. That was really putting a crimp on household budgets. Now, with rates beginning to fall ever since June of this past year, that is really allowing momentum to come back into the Canadian economy, which we think should have a stronger growth in 2025 than in 2024.
Now, what does our Spending Momentum Index look like in Canada? How is it performing?
It has, similar to the global trends, it has started to pick up as we got into the late last year. And that acceleration, we think, should continue as those interest rates, as I mentioned earlier, continue to fall.
Now, one region where we see these dynamics really play is a critical role in terms of what's happening in Europe. According to the latest outlook for the region published by Adolfo Laurenti and Hannah Heron,
Wayne, the 2025 economic outlook for Europe is dominated by uncertainty, which does not mean it's all doom and gloom. In fact, there are some positive macroeconomic fundamentals that are expected to boost consumption and support activity. Hannah, what drivers may help Europe to outperform expectations?
Think of labour markets that remain relatively tight in historical perspective. Think of wages and salaries as well that have been steadily rising despite some moderation in recent months. And then household incomes too, which are also rising and are now outpacing inflation. So all in all, the picture for the consumer appears to be quite encouraging. Add to that the expectation that central banks will continue to gradually reduce policy rates, and that will help households and small businesses to have easier access to credit in 2025.
Right, but let's briefly consider the risk to the outlook and what could go wrong. Starting with the sentiment. The sentiment remains quite guarded, both for businesses and the consumer. Europe is overly reliant on export as its main engine of growth. And as the global climate around trade becomes less favorable, there is a significant uncertainty about the future, especially for some key sectors. Think of manufacturing.
That's true. Another thing for Europe is that it's still vulnerable to energy prices, which we saw in November with the cold surge that increased natural gas prices. The fiscal side is also complicated, with many countries grappling with high levels of debt, high government deficits, and disappointing growth figures.
And you know, Anna, more broadly, geopolitical instability, fragile fiscal conditions, trade policies, especially from the new American administration, they all create additional risks that have an impact on key European industry. So, on net, caution is the name of the game.
Yes, there's plenty that can go wrong and derail what already looks like a fragile recovery, but let's not underestimate the fundamentals of the consumer, who might once again outperform expectations.
And let's underscore that, Hannah, what you just said. There is plenty that can go wrong. The recovery is fragile, but do not underestimate the fundamentals of this economy. Look at raising wages and salaries, the resilience in the labor market, falling inflation, rising income. All of that might once again help the European consumer to defeat expectations and surprise on the upside. Or at least so we hope. Thanks. Back to you, Wayne and Richard.
Now, Adolfo and Hannah raised some important reasons for concern for Europe's 2025 outlook, especially in the wake of last year's U.S. presidential election. Now, Michael Brown is going to tell us more in a minute about how potential U.S. policy changes could impact the rest of the world. But first, let's hear from him on what the economy in the U.S. is looking like as we head into 2025.
As we start the new year, our U.S. economics team expects the U.S. economy to continue expanding in 2025, but likely at a more modest pace. There are a few reasons for this. Namely, the pace of job growth is expected to remain a lot more modest than what we saw in 2024. In particular, we're expecting labor supply, those looking for work, and labor demand to come back into a little bit better balance. The implication of this is that wage growth is going to continue to hold up, but again grow likely at a more modest pace than what we've seen over the last couple of years. Finally, we do expect the Federal Reserve here in the United States to continue reducing interest rates. This will be a gradual process, meaning that most of the benefits of those lower rates are likely going to be a 2026 story and beyond. Among the more important aspects of the U.S. economy in 2025 that are expected to influence global growth is the outlook for policy changes. Let's begin with monetary policy. Our view is that we think the Federal Reserve will continue to trim interest rates roughly by 25 basis points each quarter throughout the end of the year. That'll take the federal funds rate, at least the upper bound of it, to about 3.5%. Regarding fiscal policy, Republicans now control the White House and both chambers in Congress. While it's too early to know for sure what specific policies will eventually be enacted, we're assuming that tax cuts enacted during the previous Trump administration are extended. Additionally, we expect the incoming administration to once again turn to tariffs as a tool of economic policymaking.
Higher tariffs, higher budget deficits, and frankly, higher interest rates all sound like they could push the U.S. dollar higher for longer. But what other spillover effects could we see to other regions?
During the last Trump administration, the region most directly impacted by trade policy shifts was Asia Pacific. After the first round of U.S. tariffs on Chinese imports, U.S. imports from China fell from 1 in 5 of the total to only 1 in 10 today. Simon Baptist recently worked through the implications of these changes on the AP Outlook. Simon, can you share with us your views on what's going to come next?
Yes, US trade policy certainly is going to be a wildcard for Asia's 2025 economic outlook as well. It's going to be a year of uncertainty and structural change. We've got the new US administration, and they will be adopting policies that for sure are going to have an impact on this highly trade-exposed region in Asia Pacific. Alongside that, authorities in mainland China are calibrating stimulus to try and accelerate growth and get some inflation in what is the world's second largest economy. This is Asia's new economic reality. Amidst decent global growth, we're watching 4 key themes that are going to shape the year ahead. The first, supply chain shifts. Second, geopolitics and regulation. Third, a consumer spending recovery. and finally, new patterns of cross-border financial flows. With these trends in mind, how are the region's largest economies going to fare in 2025? Asia Pacific is going to remain the world's fastest growing region, even as mainland China's economy faces structural headwinds such as declining workforce size and weak confidence amidst a property slump. Urbanisation is the biggest driver of growth, though, and combined with sufficient improvements in the business environment, emerging markets like India, Vietnam, and the Philippines are going to continue to be standout markets for growth. Demographic change is rapidly occurring, however, and economies like Thailand and Vietnam are going to face challenges with healthcare, pensions, and employment due to aging populations at lower levels of GDP than mainland China did, which in turn is facing them earlier than Japan or South Korea. Amidst the region's more developed markets, wage rises in Japan and moderating inflation in Australia should see a consumer recovery in those markets as well. Technological change remains a bright spot, with much global cutting-edge innovation from semiconductors to electric vehicles taking place in Asia Pacific. Patterns of cost advantage are changing, technological capabilities are evolving, and consumers are moving into the global middle class, creating a diverse and dynamic business environment to navigate in 2025.
The previous set of tariffs led to supply chains shifting from China to other areas within and outside of Asia.
You know, and we've seen that happen where that even continues today. The aspect of moving supply chains to areas outside of even China and other Southeastern Asian countries continues. I'm seeing a lot of businesses focus more of their efforts in terms of determining where new factories should actually be at, thereby altering some of the supply chains. You seeing something else different in Latin America?
Latin America is one of the key areas that has benefited from this trend over the last decade. And, you know, it's not just that they're supplying into the United States, they're also increasing their ties to China as well. And one case in point is the fact that we have this new deep water port in Chanque, Peru. Now, to help sort through the push and pull of these changes in China and the United States and what it means for Latin America, let us now turn to Joel Virgen. Joel, take us through your views on how this will all play out in 2025.
Thanks, Richard. In Latin America and the Caribbean, we expect aggregate economic growth to decelerate from 2% in 2024 to 1.9% in 2025. The largest 6 economies in the region, Brazil, Mexico, Argentina, Chile, Colombia, and Peru, will contribute with more than half of this annual expansion. Notably, Argentina may return to economic growth this year. LAC is influenced by the global economy through exports, remittances, direct investment, travel, and even financial markets. Thus, there are concerns about the regional impact of new US policies and a slower growth in China on local economies in 2025. A scenario in which the US imposes tariffs on Mexico, resumes a trade war with China, and tightens immigration policy should have a more adverse effect on Mexico, Central America, through the manufacturing and remittances transmission channels. Meanwhile, indirect effects may be felt in Brazil, the Andean region, and the Southern Cone in the form of lower prices of industrial metals, grains, and protein, due mainly by weaker demand from China. In contrast, a firm US dollar may overall be favorable for LAC via remittances, tourism, alongside with export competitiveness. Inflation is projected to converge back within the central bank targets by 2026. With this progress, we expect the central banks of Chile, Colombia, and Peru to continue cutting interest rates. On the consumer spending front, after showing remarkable resilience last year, we expect a moderation in growth due to slower job creation and tamer gains in real earnings. However, past reduction in interest rates will start showing positive effects this year. Compliance with the fiscal commitments aimed at lowering debt will be closely monitored by public opinion, financial market, and credit rating agencies. Finally, this scenario is not without risks, with one of the biggest being climate shocks that are becoming more frequent and extreme in Latin America and the Caribbean. Not only do these have the potential to distress large swaths of the population, but also can impact consumption, infrastructure, logistics, and food prices. This creates a wild card in our economic outlook due to its unpredictability to one year to the other.
So we have discussed so far a number of uncertainties about the outlook driven by, frankly, the headline news. Beyond these headlines, there's a world of possibilities and opportunities opening up, such as key trends in the region covered by Mohamad Bardastani. Mohamad, what do you have to say?
CEMEA is a vast and diverse region. I'm going to break it down by sub-region and highlight one economic story from each that's likely to have global implications. The first is the stabilization in the CIS-SEE region, with Ukraine making slow progress to restore some form of economic stability following a couple difficult years at war. Ukraine's GDP, one of the largest in the CIS region, is projected to rise by 3.7% in 2025, supported by the approval of G7 members of $50 billion in loans. The second is the significant progress being made in the Gulf Cooperation Council countries to diversify their economies away from oil dependency. The World Bank reports that the Saudi private sector workforce has grown steadily, reaching 2.6 million in early 2023. Additionally, the labor force participation of Saudi women more than doubled from 17% in early 2017 to 35% in second quarter of 2024. Further, Saudi and the UAE are becoming major tourism hubs. Saudi Vision 2030 includes ambitious plans to boost inbound tourism, aiming to attract 150 million visitors annually by 2030. The third is renewable energy trend in North Africa. Renewable energy projects in Morocco and Egypt are leading the charge. Morocco aims to generate 52% of its energy from renewable sources by 2030, while Egypt is aiming for a 58% share of renewables in power generation by 2040. A testament to that is the significant investment in Binban Solar Park, one of the largest solar installations in the world. Lastly, we have the tech boom in Sub-Saharan Africa. Sub-Saharan Africa is witnessing a tech and innovation boom too. Hubs in Nigeria and Kenya are emerging as global tech players. Nigeria's tech industry is projected to reach $88 billion by 2025, driven by the growth of fintech, e-commerce, and software development. These developments in the GCC, North Africa, CIS, and Sub-Saharan Africa are not just regional stories, they're helping to shape the future of our global economy.
Wayne, I heard some common themes in our session today. The fall in inflation and interest rates should let households and businesses resume growth in 2025.
And that's going to be an important element here across the globe. For the most part, inflation and interest rates should continue to come down, and that's going to lead to additional growth, really, for the global economy.
And you know, the interesting thing, Wayne, is although the economy as a whole is going to be lifted up, we will see greater variability across countries. And one of the key things that's going to drive that variability is what's going on with the new U.S. administration's policies.
You know, that's a big item, and everybody's talking about it. Yes, it will have a pretty big impact and a varied impact across many of those regions. This could create the variability that we're expecting to see between many different countries, depending on the action or reaction of those various policies that we see overall.
And as we monitor and update our views, how can our audience access our latest thinking on these issues?
You know, we're going to continue to monitor all of this data at a very close pace. And this information, of course, is available to you on visa.com/economic insights. We're in the process of just putting out new information as a result and when it comes out based on the new changes that we see globally. Many of these reports that we just talked about for each of our regional economists is being published, and again, keeping a close eye on that as we look forward into the future. And with that, I'll close by wishing our viewers a prosperous and successful new year.